Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And all I got to say is he's back. After a week off for Memorial Day, we've got the one and only Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you. Good to be back.
I appreciate your time, man. We've been doing this years together. I look forward to all our conversations on Monday. So thank you very much.
Yeah, absolutely. Me too.
One of the things I wanted to do first off with you is talk about new home construction. And the reason I want to do that with you, for the folks that don't know, you were a builder. You've built everything from very luxurious, huge, massive estates to starter homes in your career. I've done some research around new home construction after the really big miss from a week or two ago. Expected 750, did like 591 or something. It was a huge miss. I went back and did some research about 1979 to 82, which was a huge crash in construction or new construction sales, about 48%. And then, of course, the crash from 2005, where we were building 1.3 million homes to the bottom of 300K or 319, a 75% drop. So I wanted to get your opinion as a builder, given the cost of capital, giving less buyers, given supply chains. Where do you think this new home construction goes? Because I'm guessing it's not up.
Well, when you say up, you mean units?
Units.
Yeah. Well, I think right now units in process are at the highest levels we've seen in a long time. There is a chart out there that'll show that. I don't know if you have that one or can pull it up real quick. But if you look at that, right now units in the pipeline, in construction, in process are up. And there's a couple of reasons for that. Delays, obviously, it's taking longer to get stuff finished, but starts are down. So what's down is new starts. So as a builder, you got to finish what's in the pipeline. And as the market shifts, you don't want to start anything new till you get everything else that's out there sold. But there's a lot of units in the pipeline, multifamily and single family, that have to get completed before we see what happens. And then builders are very in tune with what's going on now. 2009 taught us all a big lesson.
Yeah.
We're very sensitive to demand cycles and to interest rate and the effects of interest rate. As a builder, I've been talking about the housing market being directly inversely related to interest rates. As a builder, that's what we watch, because we know they're buying payments. It's affordability. And, from a new construction standpoint, if I built a house that, was selling at 500,000 6 months ago, that house is going to sell for 300,000 now because of the payment affordability. And I mean, interest rates have doubled.
Yeah.
So it almost has cut the, prices of houses in half. So I think, that's what we're seeing. And whether or not, what the future looks like, it really all depends on, where interest rates go, how much demand destruction is really done, how much existing home sales stock, starts to rise because you build when there's no inventory, right? Or when cost of replacement is exponentially cheaper than resales.
Right.
So that's when construction booms. When it's cheaper to build than buy, construction booms, especially if there's no inventory, or limited options. And then we've seen peaks when there's been a lot of high inventory, but new always sells better, and you can build cheaper generally than the resale market. So you have a competitive advantage. But to your point about the 70s, it was 40 years ago that we saw inflation at the levels that we're at now. And I remember my parents sold a house that we moved from Pensacola, Florida, in 1984, 83, 84, and they had to give a second mortgage to the buyer because they couldn't sell their house. And it was a great house in a great neighborhood. We had a pool, cul-de-sac. It was just terrible housing market, time. That's my only experience with, the housing market back then. I was 11th grade at the time, but those are my thoughts on what's going on.
Yeah. And I want to go back to it because I think there was something subtle there that I wanted people to pick up on. I think the builders are much like, it's kind of like Walmart and Target, sort of. And what I mean by that is Walmart and Target clearly over ordered or double ordered, or the supply chain was so delayed. Right now, these institutions, given the last earnings, have 40% more inventory than they normally do. And I think what's happening with builders is, they were building, a lot of builders, I think 9 or 10 months ago, because lumber was so high, they were just pouring pads, right? They were just pouring the pad and they were waiting. And a lot of that counts as inventory in the pipeline. So if you're in the market for new construction today, given that I think there's going to be a mismatch between willing and capable buyers and the pipeline of existing stuff, do you think new construction is going to start offering discounts and buying points? And it might be an area where there might be some pain early because they got to sell, right? They don't really have an option to pull it off the market. They've got to sell. They got to turn their capital.
Yeah, it depends on the market and depends on the inventory. I mean, obviously there's all different levels. Starter homes are very different than move up, very different than luxury homes. But yeah, I mean, you're going to see the builders, provide incentives, discounts, creative financing first and foremost before any other segment of the market. I bought my first house after I got married in 1990, and I bought on what was called a 3-2-1 buy down because interest rates were so high. And the idea was your income would go up as a first time home buyer as you're in the house. So the interest rate would start lower and it would go up through time so that we could qualify for the mortgage. And that was a builder incentive type program that was offered at the time to make that work. I can't remember all the details around it now, but yeah, you'll see it start to show up there. But again, it just depends on the market. Like my market that I'm in, we're seeing price reductions, but stuff is still selling quickly, the good stuff in the right areas, and the stuff we're seeing $50,000 to $100,000 price reductions on $500,000 homes, but they're way overpriced to begin with. So
yeah,
that's what you're going to see, and we're seeing it everywhere. So when you say crash, and a lot of people are talking about crash, we got to define what is that exactly?
Yes.
What do you mean by crash? And what we're seeing obviously is mortgage applications are way down for refinance and acquisition. We're seeing new construction traffic way down. We're seeing price reductions, so values are coming down some 20-30%. Is that a crash? So you got to really define what is meant by housing crash. And everybody was calling for the crash, back when the pandemic was happening and the forbearance program and all that. You and I said that's not happening.
Not happening.
Interest rates is what's going to correct and potentially crash the market. And we were pointing toward the end of this year, going into next year, rates rose a lot faster than we both thought, I think.
Oh, absolutely.
But builders have other exits too. So if you're in Charlotte, North Carolina, and you're building starter homes or move up homes, and you've got 100 of them in inventory, you can sell that now to a fund that's going to buy them and rent them.
Exactly. So, I see that.
So, there's different exit options for builders in different markets. So it's just such a very unique time right now versus 2009. There was massive inventory everywhere, massive.
Yeah.
So liquidity dried up, credit, people couldn't borrow money. Values were coming down, and there was tons and tons and tons of inventory on the resale market because of all the foreclosures, as well as new production coming. This time we've got everything but massive inventory, out there for the resale market. We've got new construction coming. We've got really high interest rates, and it's going to get more difficult to borrow money. Credit's going to tighten.
Yes.
So it'll be interesting to see how long it takes for, things to fundamentally change.
Yeah. The one last question I want to ask you as a builder, because I have no experience with new construction, is I think you're right. I think it's really a two-step function. There's the existing inventory that's in the pipeline, as you say. And then there's, okay, what are we going to do next? Right. What are we going to do next is a different discussion, because they could go smaller. They could build less units, lots of choices. But how long for if you're a builder and you're looking at your inventory board or whatever you're tracking, is that like 6 months into the future? Like you're already committed for supplies and labor for is it 3 months? Is it a year and a half? How long is this pipeline, you think?
Planning units ahead?
Yeah, like earlier you said it depended on how much inventory was coming, right? Because we have record inventory coming. We talked about pads being laid. That stuff has to be built, right? It's already kind of in the pipeline. Generally speaking, how long is that, you think?
Depends on the market. When it's red hot, you're just going as hard and as fast as you can because everything's being bought as soon as you break ground. You're taking pre-reservations. Generally, builders, we look at absorption, right? Can the market absorb the units we're bringing to the market, and what is that absorption rate? And I just put something in the chat I think you're looking at.
Yeah, I'm pulling it up.
Yeah. So he's a housing expert that he puts out a lot of great information and charts. I think he's with who's he with?
I'll scroll up. Sorry.
Yeah.
Housing Wire.
So yeah, Logan, he's all this stuff we're talking about, man, he puts up charts and data, and he's really dialed into the market. So he's a really good one to watch for people, and a lot of great indicators there. That's why I wanted to put it in. But anyways, as a builder, you're going to forecast with absorption. And that's one thing that Logan talks about. He's got couple of things about absorption rates. And generally, as a builder now, you don't want to be any more than 6 months ahead of the market because it can change so stinking fast,
Gotcha. And that's what I was looking for. 6 months.
It's really funny because when I was first starting in the industry, all the old schoolers that went through the 80s and 90s housing crashes, they all said, hey, it turns off like a water faucet, literally overnight. And I was like, man, that's hard to imagine that happening as busy and robust as the market was when we were all going, and then all of a sudden, 2008, 9, it shut off like a faucet.
Yeah.
And here we are, 2022, and it's shutting off like a faucet because interest rates, shot up so fast and corrected, so quickly and so hard. And, that's what really drives home that point. It's all about interest rates. So as builders, we watch interest rates. We watch the lending market. What does that look like? We watch, days on market. We watch, pending sales. We watch absorption rates. How much inventory is there and how long does it take to absorb it? And those are the things that, especially now, you want to be the most nimble with. But like I said, now builders have other exits that weren't available before with, rent to own, or not rent to own, but build to rent model.
Build to rent, yeah.
So builders, worst case scenario, they'll rent. I mean, they'll stick a tenant in there and they'll rent. They'll do whatever. But usually the first case is, if they're not set up for that and their investment capital or business model doesn't allow for that, they'll just drop prices and liquidate and get out of the market.
Yeah, that's exactly what I was looking for. Because I think there are some
people. That's why starts are down too. Because they're not going to start right now. They need to clear out. That's what I'm telling you. Yes. That pipeline of existing in the process, that's up at like 2020 levels, something like that. We haven't seen it in 4 or 5 years. But starts are way down because it's like, why would you start a house right now?
Exactly. That's exactly what I was looking for. So I think if you're in the market for new homes, again, it's all local. There might be an opportunity to squeeze, if you will, builders. It's certainly worth a chance. If you're looking to buy a home last year, you couldn't get one, you're out of waiting list. I think the power is coming to you. You owe it to yourself to try. I think, as Greg is saying, we're going to have a little window, 4, 5, 6 months, because by then they're going to pivot. They're going to do less. They're going to do something different. It'll be a different market. So, Greg, I appreciate your experience. That's exactly what I was looking for. Where can people find you?
We're talking about production builders. Now, I know I have some friends that are custom builders, and those guys are booked out a year, 2 years. For people that want to build a house, they've got the money. It doesn't matter.
Yeah.
We're talking about a different business model. And again, in my area, some of the builders are still breaking ground because there's so much demand and there's so little inventory. People are still buying, and costs are still up. So that's the other thing. Builders are looking at, man, I don't know where costs are going. Yeah. Interest rates are up. So, the
labor, it's I think the housing market is in for a change. I think the slowdown is real. I think it's going to hit different markets at different rates, at different speeds. I think new construction, as you've told us repeatedly, will react first. And I think that's just wisdom and experience telling us where to look, because existing homes, I don't think existing homes move. It doesn't move at the same rate with the same urgency, right? It's a different, you don't have to move, right? You can take it off the market as an existing homeowner. So
especially in different markets. So if you're in a resort rental market, where there's a lot of short-term rentals, then, over the last few years, anybody who's bought, 2 years ago, whatever, they've got such low interest rates and they have good cash flows. That's always been one of the most unmotivated markets for sellers, because they're like, hey, I got this great cash flow. I'll stick it out there at this price. If it sells, great. If it doesn't, I'm still renting. So those markets are hard to really analyze, although now the cash flows don't work. So you'll see transactions drop in those markets. You'll see that, inventory start to rise rapidly in those, resort markets. But, again, home builders, they learned a huge lesson in 2008, 9, and they're watching data closely. So builder sentiment and builder starts, that's a good indication of what the housing market looks like, because we have real-time data. We know what's going on, and we're not going to start houses if we don't think we can sell them.
Hey, amen to that. Greg, where can people find you?
Yeah, gregdickerson.com.
Thanks, buddy.